Today, the stock market closing out its worst first half of a year since 1970. Stocks falling across the board on the final day of the second quarter as inflation remains stubbornly high, most noticeably at the pump, even as OPEC decided today to ramp up crude oil production. Joining me now to discuss the state of the current economy is Dan Ricardo, finance professor at the University of San Diego. Thanks so much for taking the time for us. Stocks again way down today. The U.S. consumer spending falling for the first time this year. Obviously, traders think the economy may be buckling. Do you agree?
Yeah, hi, Rutabaga. Good to be back with you. It sure feels that way, doesn't it? So consumers are finally starting to feel the pinch of these higher prices and react by pulling back a little bit, just buying less stuff, going out to dinner a little less, and that sort of thing. And as you said, the fear is that spirals into a recession, right? The economy starts to shrink. Folks lose their jobs, or at least some folks lose their jobs, and that's not good for anyone. So that's kind of where the market is right now, a little bit spooked by the fact that inflation's high, interest rates are going up, and the consumer is finally pushing her purse strings back a little bit.
And tech stocks in particular, they're having their worst year ever. What happens next? How does the tech industry affect the entire market?
That's a great question. So tech has been a leader the last 2-3 years in the market, but there's really two types of tech companies. Tech companies that make money, tech companies that burn money. So funnily enough, investors are finally waking up saying, gee, I think we want to put our money into companies, stocks, that actually are going to make some money in this environment. So it's not unusual, Rutabaga, that we see this rotation perhaps out of some of the tech names and into some more companies that actually make some money.
And I want to talk to you about a key inflation gauge that's monitored by the Fed. It's called the PCE index. It remains high at 6.3%. For average people like me, explain to us what the PCE is and why it's important to monitor.
You don't talk about PCE when you're out with your friends for dinner? Come on, Rutabaga. So, look, the reality is, forget the acronym. It's really simple. You go to 7-Eleven, you buy a slushie, it's 10 cents more than it was last month. That's inflation. And the Fed has different ways of measuring it, looking at it. The PCE is the index that they use. Today, we had a pretty bad reading, meaning it's still elevated way beyond where the Fed wants it to be. Bottom line, investors are looking at that saying, that means more interest rate hikes are coming. That generally means that the economy will slow down, and that could ultimately hurt corporate profits.
Well, I hate to leave it there, Dan Ricardo, but thank you very much for joining us. We got to run.
You got it. Take care.
Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.